team members on there. Great to see you. They're more popping on every second. That's awesome. So some of you won't know who I am, but I'm Jeff Marchant. This is my wife, Lynn, with the Marchant Real Estate Group, brokered by EXP. Our team is about 78 agents in 6 states right now. So we're having a lot of fun, and we asked Josh to share some of his knowledge and wisdom with our team. I've had a sneak peek of some of the content he's going to share today. So I'm super excited, and I know we are blending together Josh's normal training with, so we got a lot of mortgage people jumping on here. I know from Facebook, we got a lot of investors jumping on here. We're going to have real estate agents. So we've got more of a blended group than we're used to. So I'm happy to meet you all. And Josh, like I said, I kind of like to start as close to the top of the hour as we can. Looks like we've got about 44 on here. We're expecting probably, triple that to jump back on, to jump on here. So if you're good to go, and maybe somebody will have to catch up on the recording to see the intro. Josh, I've known Josh for 15 to 20 years, somewhere in there. And
20.
Has that been 20?
20, yeah. Because my wedding was 16 years ago, so it has to have been 20.
Yeah, absolutely. That is crazy. Time goes by fast, but it's been a great relationship. It's been a great friendship. Josh has done a lot of loans for me, for my team, and it's just been a tremendous relationship. And watching him grow his business over the years has been inspiring, to say the least. And a lot of you know what I'm talking about. Most of you know Josh, obviously. And so, Josh, I'm going to turn it over to you and let you add in any other intro that you want, and kind of roll in today's training.
Cool. Thanks a lot. Well, first of all, I will just say that I'm really grateful for the opportunity to be here to speak with you and for everybody that has come up. So thank you, Jeff. Thank you, Lynn. Thanks for Eric for giving me the platform. And this conversation was one that Jeff and I had a little while ago to a smaller group. And the premise behind it was this, team. I believe as both real estate and mortgage professionals, we should not only be able to explain what's happening in the real estate market, but why. And we should be able to leverage those opportunities when people ask us about what's going on in the market to show that we are experts and we have a deeper understanding than just about anybody else in the market. Ultimately, I think people use professionals because they trust them, and they think that they're going to be able to advise them, and they're going to be able to put them in their family in a better position than if they use somebody else. I've studied Dr. Cialdini for years, who's written books and done podcasts and all kinds of cool stuff on influence. And there's that moment when a client says, gosh, I'm scared. I don't know if I should, just wait for the real estate market to turn around. What do you think? And at that moment, that's the moment where we have been given the microphone and we've been given the magic wand in terms of our influence, in terms of our authority, in terms of our ability to advise that client. And, I shared a story when I gave this presentation the first time to Jeff that I was listening to a realtor's YouTube video. And in the first 2 minutes of the YouTube video, the headline of the YouTube video was, Utah's real estate market, what's happening, or something like that. And then in the first 30 seconds of the video, they said something to the effect of, well, I don't know what's going to happen to the real estate market. If I did, I'd be retired and I wouldn't be selling real estate. And I went, oh my gosh, man, that was such a golden opportunity for us to step into the light and be able to use our authority and our expert. And I just want to make sure that all of us don't make that mistake, that we have enough data and enough analytics and enough understanding of what's happening in the market, that when a client or a friend or a family member asks us that question, we can step into it and maximize our authority and influence. And I don't mean influence in a bad way. I mean influence in a great way, influence to make a family make the correct decision for them. So with that, I'll kind of just jump in. Oh, I remember what I was going to say. I lost my train of thought for a minute. I gave my first live presentation this last weekend. And what I realized, there was a group of us of Neo Home Loans that came together. And what I realized was how much more I like presenting in live person, because I can hear people, I can see their faces. And on Zoom, it's so muted. Like I have no idea if Lynn is nodding her head up and down, or if she's going, he's crazy. Like I can't tell from here. So maybe both. He's crazy. So what I would encourage you to do is to give more feedback, and just feel free to come off mute and ask a question, because it really helps me gauge if you're duplicating and if we're, what I'm saying is landing for you. And it also gives everybody else an opportunity to hear a question and think a little bit differently about the information I'm presenting. So please, the more feedback, the more questions, the better, if you will. All right, with that, I'm gonna just jump in and make sure my screen share is working okay. Can I get a thumbs up from Lynn if you can see that? Cool. All right, we're good. Thanks, Kathy. You're topping my screen here, so I'll be watching you for feedback. All right, so the topic today is the current state of the US housing market. And again, to kind of go back to what I was saying before, the goal here is to present you or provide you with data and facts. We want to go from my opinion is that the real estate market price is too high. Why? Because it's never been higher. Okay, but just because the price of something has never been higher, that doesn't mean that it's not going to continue to go up. We need to move away from opinion and suspicion and hunches, and we need to move into data and history and analytics. And we want to be able to have those conversations with clients to give them really, really great advice. You're going to get a copy of this slide deck. I hope you will pull the slides out and put them in your listing presentations, your buyer presentations. I hope you'll put them on your iPads and your iPhones. And when people say, hey, what do you think is going to happen to the housing market? Prices are kind of high, right? I hope you'll pull these slides up and say, yeah, they are high, but let me show you a few slides and a little bit of data that I've been keeping my eye on. So I want this to not only be an hour together, but I want this content to live in your presentations. All right. Real quickly, I'm going to just bring this to your attention. This is the NEO mission statement. All right. We believe that the mortgage industry is way too transactional and interest rate focused, with very little strategy for staying in buyers' lives over the long term. Our mission at NEO is to foster financial literacy and build relationships that continue to add value long after the buyer's loan closes. We believe if we're doing our job right, the loan closing is where our relationship begins. Now, I share that with you because I think the same thing's true for real estate. We're both under attack. The real estate industry is under attack by discount brokerages, and the mortgage industry is under attack by online discount lenders. And the difference between us at EXP and NEO is that we have the ability to have more expertise and give a lot better advice and take a lot better care of our clients. Same thing at NEO Home Loans, than do our low price discount competitors. And I started investing in real estate watching Jeff and Lynn as my mentors 20 some odd years ago. And I realized that if someone didn't take the time to give me great advice, I maybe would have never bought that investment property. And today, maybe I wouldn't have 100 investment properties because I got great advice. So to me, I'm passionate about making sure that my clients have really good advice and make the best possible decisions. And that's really my hope for this presentation. So let's jump in. I want to look at the real estate market and analyze the future price trajectory based on two simple and important metrics, which is supply and demand of housing. So we're going to start on the supply side of the equation, okay? And we're going to look at what's going on with housing supply. This to me is one of the most impactful slides and data that you could ever show a client. Going back to 1977, these are the number of US housing starts. This is the tracking of new construction. And this is 1,500,000, which of course is 1.5 million. And if you kind of just draw like a trend line through the middle of this graph, you can see that, we got as high as 2 million houses being built in, let's call that late 70s, early 80s. Oh, too many houses built. And the construction market responded by dropping the number of houses being built under 1 million. And then there was a shortage of housing, and the builders responded and went all in and moved the number of housing starts over 2 million. So what this tells me really quickly looking at this is, when we start building 1 million homes a year, it's not enough to keep up with demand. When we get over 2 million homes a year, we're probably building a few too many homes. But if you look to the right side of the screen, you'll notice that from, let's call it 2000-ish, maybe even going back to 99, we were really above the 1.5 million trend line. And the total number of housing starts that was, I think it was 2006, was almost 2.5 million. So we had a 7-8 year run where we were building more homes than historically we had built. Demand couldn't keep up. And of course, we all know, what happened with the Great Recession. And now the number of new homes cratered. And if you looked at this graph, it actually goes back to like the early 60s. We had never hit 500,000 new housing starts going all the way back to 1965. So this was like an epically low number of new construction homes. And look at this, since 2009 to 2021, we're like barely back up to the trend line. I'm going to say the trend line, or the average of this graph, if you take out the highs and you take out the lows, is about 1.5 million homes being built. And I'll show you in another graph, that COVID even sent us back more. But this gap between here and here is absolutely historic shortage of new homes being built and brought to market. Let's look at it by decade, okay? These are single family housing units completed by decade, going back to the 70s. So you got 11 million, 9.8 million, 10.7 million. Let's just call that average about 10 million every 10-year period there. And then we get into 2000 to 2009, arguably that period where we built a little more, a few more homes than we needed. I'll show you a little bit more in regards to inventory next. And then look at what happened the last 10 years. We have drastically underbuilt the number of homes that we need. So the supply side of the equation is massively short. And then COVID hits. Right when builders are starting to get their legs underneath them. I know these numbers are small, so I'll read it for you. This is 600,000 new construction homes, housing starts. We get all the way back up to 1.6 million, just right over the trend line, going back to the 60s, right? We haven't even calculated population growth yet, but we just get back to the trend line. And then what happens? Boom, COVID crushes builders for the first half of 2020. And we see housing starts go down all the way down to 1 million. And now they're just starting to recover. But this is another, we didn't have enough houses and real estate market was competitive enough. Now cut the number of new houses being built nationally in half because of COVID. What's happening? Well, we just simply do not have enough supply of housing to keep up with demand. So we get this record inventory shortage. And the amount of existing homes listed for sale as a relationship or ratio compared to American population has never, ever, since we started tracking this data, been this low. So if we go back to January 1999, we'll see that the number of homes listed nationally on the multiple listing service across the country started at about 2 million. And then as we move forward into 2005, builders get a little ahead of themselves. Inventory of homes start to peak up to 4 million. Whoops, too many homes. Stop building homes. And we start to see inventory go down. Why did the inventory of houses go down there? Because right there in 2006, well, if we go back just a couple here, we see that the inventory went down because new home builders just, pretty much stopped building new homes during that reset there. So if we follow this trend line, we had way too much inventory at 4 million. And today we have 1.03 million homes listed across the United States. Now, team, I'm not a mathematician, but let's think about these numbers for just a minute. There's 1 million houses for sale. There's 330 million Americans living in the United States. That's one home for every 330 people. That is not enough homes. That is just simply, if you look at it just from a supply standpoint, one home for sale for every 333 people is woefully undersupplied. So again, I'm not telling you anything you don't know, but what I want to be able to do is provide you with data. So when somebody says, geez, Josh, I don't know. Geez, Kathy, I don't know. House prices have never been this high. And you can say, because the price of a home is high doesn't mean it's going to turn around and go lower tomorrow, because you're not going to reverse the trend in home prices until you reverse the trend in inventory, and builders just aren't equipped to keep up. So let's move on to comparing a little bit, because what clients will do to me, and maybe they'll do to you too, is they'll say, well, this feels a lot like 2006. The prices of houses are crazy. Everybody's got a new Ford pickup truck. It seems like we're getting into this little crazy period of real estate, which again is all subjective. And so what I want you to be able to show them is say, well, let's look at it, right? This is the month's inventory of existing single family homes for sale. In 2004, inventory was 3.9 months, which means if you take the number of, sales in a month, divide that into the inventory, you're going to sell all the homes on the market in 3.9 months if new houses don't come to market. 2005, it goes to 5 months. 2006, it goes to 6.4 months. And then in 2007, breaks, stop building new houses. We have 9.6 months worth of inventory. So that was then. Let's look at now. Let's see, the trends here. 2017, 4 months inventory. 2018, 3.7 months inventory. 2019, 3 months inventory. 2020, 2.1 months inventory. And I think if this slide was updated to show the first quarter of 2021, I believe that number would be in the ones, not even, this is national, obviously, team. So when somebody says it feels a lot today like it did then, that's subjective. This is data. As inventory goes up, prices are going to go down. As inventory goes down, prices are going to go up. So today is nothing like 2006, 2007. When you look at it from a supply side of the equation, meaning how many houses are out there. All right, and we're going to get into the demand side of the equation. Hopefully that's the slide that really blows my mind and kind of puts this all together in terms of making it make sense. All right, so what does this look like nationally? Is Utah different? Is this something that's going on all over the country, or are there areas in the country that are starting to crash? Well, this is the year-over-year change in housing inventory. You can see that nationally, the United States has 52% less inventory this year than we did last year at this time. Utah, I think Utah is leading the pack here, down the least amount of inventory. Yeah, I believe it is. So Utah is down 68% of inventory of housing for sale as compared to last year. Now, why? What happened? How come housing inventory is down so low? Well, if we just pop back real quick to our COVID slide, we see that just when new construction was getting up to the trend line, boom, we lose half of our new home that should have been built last year. And because we have less supply of housing, of new housing, we just have an inventory shortage all around. So I'm going to pause because the next slide kind of transitions me into more of the demand side of the equation. Does anybody have a question?
Josh, just a quick comment. It's great material. I was swiping and adapting and trying to truncate this a little bit. And one of the slides I was looking for, but I couldn't find, what I needed. Barry had a good slide, was the Housing Affordability Index that's updated to right now. And I think that's a really good chart to show. There's one that goes through 2019 and what's expected in 2020, but I couldn't find one. I think it's a National Association of Realtors slide, but as I was like going through your presentation and just trying to teach it to myself to then, give some color to clients, I felt myself really wanting that. I did give this to 2 or 3 buyers that were on the fence, and all of them were like, I had no idea. And the realtors were like, you are the man. Thank you so much for doing this. So for any of you who might be, a little reticent, it was crazy, the results I had with an 8-minute presentation on this. So thank you, man, for doing this.
Yeah, you're welcome. And I unfortunately don't. I looked for that same slide after Barry's last presentation. I cannot find an updated one. So I'm gonna reach out to a few friends and see if I can find it and get it to you, because I think that would be a great addition to this slide deck. You're spot on. That is the slide that I'd love to have in here as well. To be continued, Mark. All right. Again, if anybody has any questions, feel free to come off mute. All right. So that's the supply side of the equation. Bottom line, not enough. Woefully not enough of supply of housing. But this slide is more important. And I always rush through this slide, and I literally stared at this for 30 minutes this morning as I was, and I won't make you do that, by the way, but I was really enjoying my cup of coffee this morning. And this is the most important slide in this entire slide deck, in my opinion, because when we think about the trajectory of price of any asset, of anything that a human desires that has utility, I believe we need to think through, does it have utility? Yes, especially after COVID. It has more utility than ever, because I figured out I can't work and homeschool my kids in the same house that I did before when I was at the office and they were at school. So the utility for housing arguably has never been higher. And what are the supply and the demand dynamics at play? And if we can wrap our arms around those 3 components, what's the utility, what's the supply, and what's the demand, then I think we can have a really clear view on where price is going to go for that asset or for that service or whatever it is that we want to use. So this is the number. Let's see, I'm getting pinged here, so bear with me. Just want to make sure I'm not missing something here. Oh, Colin, I think since you're the host, if you see any chats I need to respond to, just come off mute and let me know. All right. So these are the underlying births for each generation. It's the number of US births by year and generation. And for right now, don't worry about these yellow arrows that say 33 in 2006 and today. I want to just make sure we duplicate the underlying graph. So if we look at the silent generation, which was, coming out of the Great Depression, World War II ending, we had the birth rate in the United States during that period that was about 2.5 million in US births. And then we get into the baby boomers. And this is really historic population growth. Hi, Kathy. She's in that group. And we go from 2.5 million births in the US per year up to over, it looks like 4.25 million, over 4 million. And if you look at the difference over that time period, you had 47 million in the silent period. You had 76 million baby boomers, and then Gen X comes, and we see kind of that hangover effect. The honeymoon must have worn off after World War II at some point, and we see the birth rates go down. Interesting correlation. I believe it was January 1973 when Roe versus Wade was passed. So we now had abortion to contend with here. So not only the hangover from the baby boomers and that population coming down, but now you had Roe versus Wade pass. And so now you had, lives that we didn't have because of that court ruling. So Gen X has 55 million. Millennials, and that's why the National Association of Realtors keeps telling us, millennials, first-time homebuyers. Well, because this is the biggest pickup in birth rate since the baby boomers. And then we get Gen Z, which is they have this post-millennial, which I believe is Gen Z, and you've got 61 million. So here's where it gets super interesting to me, is that the average age of the first-time homebuyer is around 33 years old. Some years it's 32, some years it's 33, some years it's 44. Let's just call it 33. So in 2006, we had just over 3 million people turning 33. Why is that? Because back here in the 70s, we had this reduction in population growth. And if you fast forward those people being born in those years, 33 years later, you have less first-time homebuyers. So now this doesn't look substantial, but check out these numbers. If I've got a good 5 to 7 year run here, maybe a 10-year run with the baby boomers, where we have 4 million births, 33 years later, you have 4 million people every year becoming first-time homebuyers. And now, right where we had the oversupply of housing and builders going crazy. Remember in 2006, home builders built almost 2.5 million homes, which was the most amount of homes ever built in the history of this country. Well, right when that happened, boom, demographics fell off a cliff. And now we have this 5, 6, 7 year period here where we had 25 to 30% less first-time homebuyers. So it was a double whammy. And nobody saw it. They didn't see the population starting to go down after the baby boomers. They didn't see the impacts of Roe versus Wade. We have less first-time homebuyers. Imagine if, in a normal market, if you had 30% less buyers, you're in trouble. But that wasn't the biggest point. We had 30% less first-time homebuyers. I got to go back to this slide. We had 30% less homebuyers right here, right as home builders had spent from, let's call it 97 to 2006, almost 10 years in a row, they were building above the trend line of 1.5 million homes, all the way up to 2.5. Now, stack on top of way too much supply, not enough demand, and loose, crazy lending standards, and we all know what happened in the Great Housing Recession, okay? So that is not the what happened at that time, that's the why. Way too much supply, not enough demand, lending practices got too loose, Chernobyl event. All right, fast forward today, team. This is what's so important. So now we have our millennial population turning 33. They're becoming the age of the average first-time homebuyer. And our population growth is now back up to 4 million. And it doesn't really fluctuate that much. I mean, we barely pop under in the next 5 years. We just barely get under 4 million new first-time homebuyers. And then boom, population starts to rise back up. So team, we have 20-year run here ahead of us of first-time homebuyers above or right about 4 million per year, which is a longer run than we had back here in the baby boomer run. So this population growth going forward is very, very bullish in terms of demand. Let me pause there for a moment and just see, how is this landing for you? Any questions?
Josh, I'm sure I could count this out, but how many years is it before we start to see that slight dip? And is there any data that kind of correlates the massive imbalance that we're currently at with how much relief that would provide?
That's a good question. So I've got another 5 years before we start to dip below 4 million. And Danny, it only looks like we get down to like 3.9 million, right? So you're only talking about 100,000 less first-time home buyers. And, I think the question, so the question is, if I look at both sides of the equation, I think 100,000 less buyers is not significant divided by, 50 states. So I think demand stays fairly high from a demographic standpoint. I think the question that would really be the answer to your question is, what happens on the supply side of the equation? Do builders all of a sudden, have less regulation, buy more land, be able to buy cheaper lumber, and start 3D printing homes? I mean, if something like that came around that would drastically reduce the cost of housing and could increase the amount of supply, then I think that is something we need to be looking for. But with current technology, red tape, cost of lumber, the amount of time it takes to get a subdivision through, the county and approved, and I mean,
Even so, yeah, no, I think this is a good point, Josh, because even so, let's say all of the perfect storm of events happens that would provide relief to this, it would still take years of implementation to get those technologies fully rolled. And there would be a ton of line of sight on that, right? If a bunch of 3D printers of houses started getting manufactured, that then maybe there's a lead time to that. And then there's the period of time where the backlog gets cleared, where line of sight happens on that. And it's a long time with a lot of foresight to the event where we're actually back to a stable market, let alone one where we are concerned.
Yeah, and let me throw one other piece. Ryan Morrow in the chat just put a great point. There's 2 different government proposals right now with massive tax credits for first-time home buyers. And these are in the $15,000 to $25,000 tax credit. So again, that's not a tax deduction. A tax deduction is I don't pay income on $25,000 of my income. A tax credit is I made $100,000. I need to pay $25,000 in taxes. I'm just using hypothetical numbers, and I'm not taking a $25,000 write-off. I have a credit, which means the first $25,000 of my taxes I don't have to pay, which means now I've got money for a down payment. So, I mean, in my opinion, the government is doing the exact wrong thing at the wrong time. Incentives should be to home builders to be able to, build affordable housing, not to put more fuel on the flame. And so that's the other side of the equation, Danny, is what does the government intervention do? Hard to know, right?
Yeah, absolutely.
Cool. Anybody else have a question there that you'd like me to cover?
I have a question.
Please.
Okay, so for those of us that graduated high school in 2009, maybe you could go over something for me. So the cause of the crash in 2008, 2009, I get was from a decrease in population, loose lending standards, and we were oversupplied. But I have people who think, oh, it's just going to happen again. So what has changed in the lending standards that's going to prevent another 2009?
I owe you $20 because you literally just set up my slide two or three years ago. So
That was amazing.
That was really a perfect question, and I'm gonna try to answer that two or three slides down the road. Really great question. Cool. Anything else? All right, I'm gonna keep rolling. Really appreciate the questions. Thank you. Okay. So this is just, somewhat anecdotal, but, it does speak to supply and demand issues. So I found this slide. This is Lennar. They're the largest, home builder in the United States. And to Danny's previous question around, like what would have to transpire for us to kind of catch up? And I found this slide really interesting. So in 2020 alone, Lennar builds 53,000 homes, and it currently has a backlog of 9.5 billion, thanks to incredibly high demand and limited supply. So team, it's not like the builders are going to start crushing it tomorrow and build and start eating up all that demand for existing housing. They can't even keep up with the demand, and they're so far backlogged with the demand for orders they already have that it's not like I can't see any world that they turn the key tomorrow and start cranking up enough homes to eat through their backlog and take ground on all the other demand for housing. So I just thought that chart was amazing. If you look since the crash, the $9.5 billion of just orders that they just can't even get to. And good luck getting lumber for that many houses right now. All right. Again, I want to go back and forth too, but this feels a lot like the Great Recession. Okay, let's look at then versus now. Okay. So 2002, 2003, 2004, 2005, average annual appreciation rate nationally 10.3%. Hot areas of the country were drastically more. This is just, averaged out. 2017, 2018, 2019, 2020, 6.3% annual appreciation rate. So yes, certainly we're having a great real estate market and prices are going higher, but not nearly at the pace they were in 2002, 2003, 2004, 2005. Now, I believe that's because the lending standards are much more in check. And I'm gonna get to that slide here in just a moment, I believe. One other thing that I like to show clients is that in 2006, there was a tremendous amount of cash out refinances going. And this speaks to the loose lending standards. The term is people were literally using their homes as ATM machines for vacations and RVs and boats. And so if you look at a couple of these factors, the amount of tappable equity is equity greater than 20%. So if you have 50% equity in your home, meaning your home's worth 400,000 and you owe 200,000, that's 50% equity. But tappable equity is only the difference between the 50% equity you would have in that equation and 80% loan to value in your home. So in other words, even if there was a market fluctuation, you'd have plenty of equity, and tappable equity is generally what you can get on a cash out refinance. That's how much you can pull out. Well, in 2006, there was 4.6 trillion in equity. In 2020, there's 7.3 trillion in equity. Why is that important? Well, if I have $100,000 in equity in my home and my house value goes down by 20,000, I can still sell. So the more equity you have, the less foreclosure risk you have. And that bodes well for the market as a total, because what was happening in 2006 was 4 of my neighbors just fire sold their home through a bank sale or foreclosure, and my value's now down $300,000, and now I'm forced to sell in a foreclosure sale. Well, the more equity you have, the less chance that happens. All right, percentage of cash out refinances in 2006. 89% of refinance loans were cash out refinances in 2006, literally ATM machines. 2020, only 33%. Total cashed out, $321 billion pulled out in 2006, $153 billion pulled out in 2020. Percent of tappable equity. So in every characteristic between then and now, what I want to be able to show is 2006 and 2020 is nothing alike other than prices are high. But every other data point says we're very, very different. All right. So this speaks to the question about mortgage credit. and let me try to, make sure I slow down to explain this slide correctly. But the Mortgage Bankers Association created a mortgage credit availability index. And essentially, the higher the number on the index, the easier it is to get a loan. So when you're, when the score gets over about 600, you either have to have a pulse or you need to know how to spell your name to get a loan, but not both. Just either one of those will do, and you're approved. We'll give you cash out loan, no problem. And so credit standards just got nasty, right? No income, no asset, 1 day out of credit, 1 day out of a bankruptcy, no standards. And really what happened at that point is underwriters and the people writing these underwriting guidelines, the industry, let's say, lost track of one simple thing. If you borrow money, you should have a likeliness that you can repay the money. And the industry lost sight of that. And they thought, well, if home prices always go up, we don't really need to make sure people can pay us back. We just need to make sure that they can refinance. So as long as credits are easy, even if they are on negative amortizing loans and their balance is going up, it's okay because they'll just refinance with another sucker lender and pay us out. That was where the industry got confused. And when the demographic shift came, when builders saw that as a signal for demand and started building too many homes, it didn't end well. So then we see this mortgage credit availability index just drop like a rock. And I believe this reading between 100 and 200 is the lowest that this index has ever been, which means that it was very hard to get a loan. Like Jeff and Lynn, you and me were not getting loans in 2011. Like that was tough, or 2010. Those were tough years for self-employed people. It was more difficult than I can ever remember in my career. All right, so, and then you'll see that lending standards started to loosen up just a little bit. We get back up to this 200 mark, and then what happens? COVID, back down with the credit because, everybody's worried about default risk. And so they tightened up underwriting standards, have to do a verification of employment the day of closing to make sure that, we still had jobs. So this is one that I think could be useful for you to explain the difference of this is why the credit markets were way out of hand. And this is the tracking now showing that lending standards are tight. Bottom line, people have to have some skin in the game. They have to have decent credit, and they have to have an ability to repay that loan, meaning that their income is actually calculated and there's enough ratio between their income and debts to make that mortgage payment and actually pay off the loan without having to refinance. One more slide. This is the default risk. This is done. I'm busy. Sorry, I'm going to have to call you back. Sorry about that. This was done by the Urban Institute. And the Urban Institute is really a think tank, not necessarily just a real estate think tank. And they break it down into two different categories. They call it product risk. How risky are the mortgage products that people are getting? And then they break it down to borrower risk. How risky are the borrowers? And we can see we got above the reasonable lending standards from 99 until the crash. And so what would product risk mean? What does that mean? Stated income, stated asset, poor credit scores, negative amortizing loans. For anybody who doesn't know what that means, it means your interest rate was at 6%, but you were only making a 2% payment. And so the difference between what you were paying, it got tacked on to your loan. So every year, instead of your mortgage balance goes down, your mortgage balance goes up. All those types of risky lending products was a false indicator to builders to keep their foot on the pedal to the metal and keep building more homes, because the loan products had gotten too risky and too aggressive to really assess if repayment was possible. And then you have borrower risk. What's their credit score? What's their debt to income ratio? What's their credit history? How much of a down payment do they have? Well, the borrower risks were also significantly higher back then, lower credit score standards, higher debt to income ratio standards. And so now if you fast forward, product risk is zero, like literally zero. Why is that? Because 99% of every loan in the country is either a 15, 20, or 30-year fixed. So there's no product risk. And the borrower risk is historically extremely low because you have to have good credit scores, assets, and actual income to qualify for your loan. Did that answer that question? Or
Sorry, but did you notice on that last slide, the credit availability, the dip right when COVID happened? You know, right there, you see that dip. I attributed that in my mind to, like, you know, bank statement programs, that sort of thing that was right on the fringe that totally lost funding right there. Do you agree with that?
100%. Yeah, this is all the Alt-A products we were just starting to get back, right? There was bank statement programs. If you had 20 or 30% down, you didn't have to provide tax returns, which is exactly what we needed, by the way, because self-employed people have income fluctuations and they should have ways to prove they have ability to repay a loan. And so, you know, I think somewhere closer to 200 feels a lot more like reasonableness, and anything below that is just punitively low in terms of standards, in my opinion.
Thanks,
yeah,
man.
Good call. Did I answer that question adequately around the question about the credit issues?
Yes, it makes sense.
Cool. Great. Wonderful. Okay. Just a couple more slides here. So again, this is the tappable equity of U.S. mortgage holders. So here's the definition of tappable equity: the amount available for homeowners to access before hitting a maximum 80% combined loan to value. So this would be like, you know, what home equity line companies or mortgage companies would look at and say, well, you can pull out equity up to 80% of the value of your home. And the purpose of this slide is just to show, you know, the country has never had this amount of equity in their properties, which means that people aren't using their homes as ATM machines like they did in the previous crash. And it means that even if there was a softening, that people wouldn't have to go to the banks and short sell and be foreclosed upon, because they've got a lot of equity, record amounts of equity there.
Hey, Josh.
Yeah.
Hey, one thought I had too, even the equity that people are utilizing from their homes, right now they're using it to do improvements to their home. So they're actually protecting their asset in that sense, or increasing the value.
And that's a really good point. I hadn't even actually thought about that, but I would say that 90% of the refinances that I see clients do is just what you're talking about. It's either renovation, it's buying another investment, or it is paying off, you know, student loans that assumably has some economic value to it in the future, and then reducing their overall cash flow so they can take that cash flow to invest or to pay down student loans. So I agree with you. Even the people who are doing cash out seem to be doing it from a business mindset instead of like a Vegas mindset. No offense to anybody from Nevada, but I think you know what I meant. All right, a couple more and then we'll just stop for questions. So I thought this was just interesting. Average number of offers on existing homes, and 7 seems low to me, but you know, it goes back to the demand side of the equation, that the average number of offers on existing homes from January to March of 2021, and Utah, one of the highest in the country. And so I'll end with these last 2 slides. And then if you don't mind, Jeff, I'm going to tee up the next Tuesday call and talk a little bit about that. So these are the reasons that offers are being rejected according to NAR. And so number 1 is people are offering, you know, too low, still looking for a deal in this market. Number 2 is number of cash buyers. So they lose to, other cash buyers. And then non-contingent offers. So, that's the vast majority of, and then others offers that have bigger down payments. So that's the vast majority of why the 6 aren't getting the home and the 7 who is, the 7th person that's getting that offer accepted. This is why the 6 are missing out. I thought that was, just interesting insight. And then reasons why buyers decided not to make an offer. Already multiple offers. They thought the price was too high. Hopefully this presentation will help you just a little bit with that, explain that. And then unmet desired home features and a few other things, but competition, right? That's the reason why most buyers are deciding not to make an offer. And then I'll parlay this real quickly to the invitation for next Tuesday. I have to put that up there for regulatory purposes. I'm legit, very good. I can take that down. All right, so next Tuesday, we are going to have a presentation. This is Jeff and Lynn's meeting that they do Tuesday evenings. And we're going to have Revive come speak to us. Revive is a company that helps buyers transition into a home by either buying the new property on behalf of the buyer in cash, so they could present a cash offer, and then have the time that they need to sell their existing home and then buy the home from Revive. So it essentially handles a couple of problems. Number one, the offer is more competitive because it's a cash offer and can close extremely quickly. And number two, you don't have to make a contingent offer. And then I would say number three, and then I'll open this up, if anybody sees another advantage here. But number three, I really see the housing market frozen because there's no way I'm going to sell my home unless I have some place to take Xander and Arya, right? I got to have some place to take my kids. So I'm fearful about making that decision to buy. But if I could have a company come in and buy the house, now I know I have some place to go. I can take the time to sell my house and then me purchase. I think this can be part of the solution in thawing this market. And one other thing I just want to mention is, as I continue to curate all of this data and try to synthesize it and analyze it and work through the equation, I don't see this changing quickly. And I think it's incumbent upon us to find solutions to fix these challenges that our buyers and sellers are having, because I think just waiting it out is not going to be a great strategy. 10 years ago, when I first started working in California, I remember the first deal I did was on a multi-million-dollar home in San Francisco. And the agent called me, and I'll never forget, she's like, "Sweetie, how long have you been doing loans?" I was like, 5 years, 10 years. I've been in the business a long time. "How many loans in California have you done?" "This is my first one." And she goes, "Well, let me tell you how it works here. It's $50,000 non-refundable earnest money. There's no appraisal. There's no inspection. There's no financing. And you'll close in 17 days or you're going to be on the hook for 50 grand. Can you do it?" And I was like shaking in my boots, right? And so we ended up having a really nice discussion. And she said, "This can't last. It's this, I've been in here for 20 years in this market doing business. It can't last, but you need to know what you're up against today." Well, guess what? Forward 10 years, same situation. Now it's even worse. So to think that this is a momentary blip and that if we just wait till 2022 that the market's going to be normal, I don't think so. I think we have to find solutions to help thaw the markets for our buyers and sellers and make sure we give them the advice they need to make the best decisions humanly possible.
What was the name of that company? Revive, and then was there a second part to that?
No, it's just Revive. While we're chatting, I'll put their website in the chat if you don't mind.
Oh yeah, that would be great. I tried looking them up, but I just get an essential oil company.
I think it's called it's like I Love Revive or something like that, but I'll find it for you and stick it in the chat.
Hey, Josh, let me just add in on that for you guys that aren't on our list for our next week's training. Go ahead and put in your email address in the chat if you would like an invite to this training that Josh is talking about. He's setting this up for our team, but all of you are welcome to join in on that. So just make sure I have your contact information. We'll make sure you get a registration link for that.
Thanks, Jeff. That's super, super nice of you. All right, I see a few questions here in the chat, so I'll hit those, but feel free to come off mute if you want to speak up. All right, so we got that one. Yeah, not only builders, but municipalities allowing more building and density. Yep, problem. You know, it doesn't seem to be getting any easier. We bought a 22-unit apartment building downtown. This is just anecdotal, but it speaks to the issue at hand. And we thought we were going to be a 12-month renovation. That ended up 3.5 years, and 75% of that delay was because we couldn't get the municipalities on the same page. The fire department and the building department, like nobody would see eye to eye, and that's a huge impediment for ramping up building. What numbers reflect? I'm wondering what the numbers reflect with regard to the underbuilding housing deficiency when we look at individual markets, states like Idaho, where huge numbers of people are moving in. Wow, great point, Nicole. Yes, this speaks to national numbers, and there are states like Idaho and Phoenix that are catching people that are leaving from California. And so not only are these national demographic factors at play, but then you also have the people escaping some of the coast to more rural areas. Super great point. And then Danny said another interesting note about product guideline availability is that as rates rise, more private money comes into the market with innovative solutions. Oh, you're talking about similar to what I'm talking about, right, Danny? That product we're going to go over next week.
Yeah, exactly.
Perfect. Yeah, exactly. Yep, well said. Jeff, that's all I have, my friend. Any questions or anything? I better turn it over to you for the last few minutes. Anything you want to wrap with?
I have a question for you.
Shoot. Go ahead with the question.
So we've got all the new housing that's backlogged. What's that saying for the current housing backlog? And sorry if you kind of answered that already, maybe, but I'm rather new at this.
Say it one more time. I'm sorry, I'm not 100% sure I understood the question.
Okay, so you've got the backlog of new builds, right?
Yep.
Okay, we also have the reduction in existing homes, right? So basically, I guess the question is like, how does that equate and how long is it going to last?
Yeah, I mean, I don't know that I have a direct answer for that, but as I think about that, I think that I'll go back to the three factors that I think are at play. What's the utility of the asset? And do we think housing is going to get any less vital or any less wanted? I say no. I think, people are generally speaking moving away from the higher cost urban smaller housing to things that are more spacious. So I think the utility in most of markets is going up because people are officing at home, kids are at home. Even my kids that are back to school have more half days and more days off and less time at school. So I think the utility continues to go up. I think that demand, because of those demographic trends, continues to bring a huge amount of demand to first-time home buyers. And I think that the 10-year glut of new construction supply is not going to work itself out. I mean, we're going to have to get back into building 2 million homes a year for a couple years to make up that 10 years of lack of supply. So I'd go back to answer that question with those three factors.
Josh, I have a question, or rather a comment, if I may.
Please.
I'm not real good when I have to look at charts with statistics and that type of stuff. And I just want to compliment you for the job that you've done to explain all this and put it into more layman or common terminology and so forth. And I really, really appreciate that. I know I could never repeat what you said, but your slides were terrific, your graphs and so forth. And I just want to say I really appreciate your class and how you talk about it and instruct on it. So kudos to you.
Thank you, Kathy. And I'm always up for explaining it to a client. If you want to jump on a Zoom with me and the three of us, I wouldn't take them through an hour. I'd probably whittle that down to 5 slides. But you and me could set a 15-minute Zoom meeting anytime, and I could just say, look, here's what I'm seeing, and have a discussion about it. So I'd happy to do that.
Okay, thank you so much.
Thanks again for your kind words.
Mhm.
It's hard to start a construction company.
Hey, to comment on what Kathy just said, the visuals that you've assembled, I hope everybody realizes what an asset those are going to be moving forward. Kathy's not alone when she's saying that she's not going to be able to regurgitate and reiterate the information that you just shared to a client and articulate it in the same way. Josh obviously studies this every single day. He's explained this. This isn't his first run around going over this data. So take advantage of Josh for those calls with maybe those clients that need that more professional explanation. But the charts are going to help you tremendously. It's just by sitting with somebody and saying, look at this, instead of you tell them about the demographics, if you can show them, then we hit different personality types and they're going to retain more of what you're saying. You say, oh, that makes sense. And Josh, also to you participating with some of these, I know we have agents across the country on this particular call, Florida and Washington and there, Oregon. Are you in all 50 states? Can you do loans in all 50 states? Or if you don't, I know you're close.
Yeah, thanks. We're in 42 states. And so if you're west of the Mississippi, you're good. It's basically the Pacific Northeast that we're not in. And, I would just say, Jeff, that NEO loan officers come to NEO because we're on a mission to help clients make better decisions and spread financial literacy. So if you're in Oregon and you want to work with a NEO loan officer, somebody who'd have access to this data in Oregon, will connect you with someone who's local. And so I'd be happy to, make any of those introductions. If you want somebody, you can actually come to your sales meetings.
That's
Yeah.
great to hear because I'm in Washington, Spokane, Washington.
Yep. Well, email me. I'm happy to introduce you to someone local if you'd like, Kathy.
Okay, I put it in the chat box for my email address.
Wonderful.
So one more point for you real estate agents out there. We've known Josh for a long time. He's done some trainings for our team specifically. And I know that Josh has some other tools and resources for client retention and communication with your clients that are super helpful. So if you're not aware of what I'm talking about, reach out to Josh and ask him how you might be able to team up in communicating with your clients.
Yeah, love that. I'll put my email in the chat as well. And absolutely love to hear from anybody that I might be able to help in any way.